Credit has become ever more important lately as banks have turned to credit score to kind of determine who they're going to lend to. Not only is it important to not have late payments or to not have judgments and things on your credit, but really you have to have a pretty good score to be able to go get bank financing. A 620 score is kind of the minimum in our market, and a 640 or above is really where you need to be. But you don't have adjustments to your interest rate if you're at about a 720 or above. So really your goal is to get your credit from wherever it is now to 720 or above as soon as possible. There's a few different ways that you can improve your credit that are maybe some secrets in the industry. First of all, pulling your credit, pulling a report on your credit isn't necessarily a bad thing. If you don't pull your credit at least once a quarter, your score actually goes down. If you're not using your credit, your score is actually dropping. You need to use your credit so that the banks essentially know that you will not only use it, but that you pay your payments. Besides having your credit pulled maybe once per quarter, which is actually a good thing. So if you're already checking credit for some reason, you're buying a car, you're buying a house or something and you're checking credit, then it's already getting credit's already being pulled. So you don't need to go out and spend time pulling it on your own. But pulling credit maybe 4 or 5 times in a quarter will start to decrease the score. So make sure you're not having several people look at your credit every quarter. Another thing that you can do to improve your credit score is make sure that your limits on credit cards or any account, that your balance is at half or less of the limit. Now there's 2 ways to do that, of course. One is you can pay down your balance, and let's say that a credit card has a $10,000 limit. You can pay down your credit card under $5,000 and now you're below half the limit. The other thing you can do is if you don't have the money to pay it down, call up your credit card company and increase that limit to $12,000 and now your $6,000 balance is again once at half the limit. The important thing is that you try to keep as many accounts as possible at half of the max balance you could be at. Credit score is also called a FICO score. If someone asks you for your FICO score, they're asking for your credit score. And that's going to range anywhere from, well, hopefully not as low as 500, but it does go lower than that, and up to about 850 with most of the bureaus, the 3 different bureaus that lenders will pull credit from to see what they give you your score on. When you go to a bank to get a loan, they're also going to, of course, need to see your income. There were days just a few years back when we didn't have to show income, but now everyone has to show their income. So if you're a waged employee, they're simply going to take your pay stub, they're going to average it out on the year-to-date pay for the year, and they're going to figure out what you made that year. If you're paid a little differently as a waged employee, maybe as like a seasonal worker, then they're just going to take 2 years W-2s, that's the end of the year form you receive for waged income, and they're going to average those out. So for seasonal workers, it's off of pay and it's off of W-2s. If you're self-employed, it's a totally different way to look at income. The bank will take your taxes only, and you'll either have to show either 1 year or 2 years of taxes. And what they're going to simply do is take your personal taxes and find out what your business pays you each year. They're going to take that number. You get to add back on depreciation if you have any. That's depreciation. They'll add that back if you had any, and also they'll subtract any losses you had for the year. They'll simply average out the income from self-employment or the net income from self-employment. Now for self-employed people, the goal is to write off as much on taxes as possible. So make sure that before you go for financing at a bank, that you check your taxes and see what your net income was. I have several people that say that their accountant's really good and find out that not only did they not show an income, they actually showed a loss for the year prior. So make sure that you have enough income showing on your personal tax return on lines 12 or 17 of your 1040 forms, which essentially is your self-employed income, that you have enough on those 2 lines to qualify you for the property that you're trying to purchase or the credit you're going after. Banks will not do asset-based lending anymore either. That means you could have as much money as you're trying to borrow in your account, and it doesn't mean anything to the bank. They want to see your income. So if you just simply have assets, the bank is not going to lend you money. Now in private lending, like I do, we don't care about your other assets. We're simply lending on the asset that you're purchasing or refinancing. Another really important fact for banks to figure out with you is what your debt to income ratio is. That's debt to income. Basically it's saying how much debt do you have versus how much income do you have. And those numbers need to stay in this market under about 41% if you want to get an investment loan. So that means if you make, I don't know, $10,000 a year, your payments can't exceed $4,100 in payments total. That's all your debt. That means if you have a home payment, a credit card, a vehicle loan, a student loan, they're going to look at all those payments, and then you know that you can't go above 41%.